Welcome to WisdomOwl. Today, the stock we're going to look at is from the consumer defensive sector, which is currently undervalued. We are going to look into HIMSS and HERS. Now, in next 5 minutes or so, we are going to understand how does HIMSS and HERS make money, and the financial health of the company, what has happened in last 5 years. Based on those 5 years, we'll project what can the future look like for HIMSS and HERS. And based on that future projection, we are going to evaluate if the current valuation is lucrative or not. So let's start. HIMSS and HERS is a telehealth platform which has around 2.4 million plus subscribers, right? And they provide direct to consumer access to healthcare. And they are operating in the US and UK market right now. Their primary revenue engine is their telehealth sales, which they reported in most recent quarter of Q2 2025. The total revenue was $544 million. And they're seeing considerable growth of more than 70%, which is great. They also have some high growth segments. Their women's wellness is doing very well, which they just started in June 2025. Similarly, they also have some strategic expansion. They are doing some partnerships with Oshner Health and Target to enhance their service access. Now, they're also innovating with this AI coaching, which personalizes solutions on their telehealth platform. So that's also one thing you might be interested to look into. Now, if you invest in HIMSS and HERS today, you need to understand some of the pros and cons of the business. There is a growth driver. The telehealth demand is increasing, which can be seen in their year-over-year growth. They also have some competitive advantage. They have a D2C model, and they are addressing some stigmatized issues conveniently and affordably. So that's one competitive advantage. Their financial strength is looking good. They generated 42.5 million in net income in this last quarter. Similarly, they are doing some strategic initiatives. Now, to understand some of the cons, competition and evolving regulations in this telehealth space might restrict their market share. So they might not be able to grow at this space. There are competitive threats. Other big players like Amazon is getting into telehealth, and some other conventional retailers are also getting into this space. So another operational risk is if the digital platform is exposed to cyber threat. An industry risk is with changing regulation and insurance policies, their adoption might be impacted. Now, there are still some open questions. If you want to understand more about it, you can log on to this platform, app.wisdomowl.ai, and read things like GLP-1 medication, impact on HIMSS and HERS, and some other questions. Another important aspect is to understand what has been happening in the business in last 5 years. If you see, they turned earning positive in financial year 2024-2025, right? And if you see, as soon as they turned positive, their price went from less than $10 to around $70. And right now it's trading at $43. So let's see what can be an investment thesis for this. So let's see from financial metrics point of view. First thing to note is that they have a remarkable financial transformation from consistent losses to strong profitability. Their profit margins went from negative 39% to positive 9% in trailing 12 months. This is a remarkable turnaround. This can be seen even in their operating profit margins. They have gone from minus 40 to positive 6%. And similarly, we can see their free cash flow increasing. This means they are demonstrating successful scaling of their telehealth platform. What is concerning is we can see they are taking some debt, right? If you see this debt to equity ratio, which is a red, there is a spike in TTM leverage, and this suggests there is some debt financing for expansion, potentially increasing financial risks. Their revenue growth, as we discussed, last quarter increased 70%, but if you look from 2021, they have increased by more than 5x. So that can be seen in this revenue per share financial metric. The revenue from 2021 has grown from $1.5 to close to $9. Now, which brings us that, okay, business is doing great, revenue is growing. If we want to look at this company from a long-term perspective, it's important to understand which metric to look at. And the guidance here is that it's a stable growth company in its early growth earnings stage, which makes revenue the ideal metric, right? Because earnings are so less right now. If we look at price to earnings or some earnings multiple related things, that might not give us the clear picture. So it's more important to look at it from the revenue perspective and not the bottom line. Analysts are estimating that in next 5 years, the Wall Street analyst, that their revenue can grow from 2.3 billion yearly to around 3.8 billion, right? And at what growth rate it has to grow, say every year, to come up with some number close to this. If they can grow at 15% their every year, right, at an average 15% every year, their revenue can go from 2.3 to 4.1 billion in next 5 years. Now, is it possible? Yes, it is possible. There is a full analysis of how this 15% revenue growth can be achieved and what could be the potential levers in order to do this, positive and negative. And then you might have some more questions like how they are going to improve their cash flow situation. You can log on to our platform to read through them. If they can grow their revenue for next 10 years at 15%, then $109 today is also justified. You can get good returns at $109 today if they can grow their revenue at 15% for 8 years. They have to grow at 15% for 8 years for $109 to be a fair price. The current price is $43. Even if they can grow at 10%, that price is going to be between 43 and 109. So even at 10% revenue growth for 8 years, 43 is a good valuation. It is undervalued in that regard. So if we look at this graph, this is the price to sales ratio, right? Now, their current price to sales ratio is 4.7, which means market is paying 4.7 times their current revenue or their current sales. In the recent past, it was trading at more than 10 times its revenue. This is definitely lower, but is it the best time to buy? Probably we can see it was trading at less than 4 very recently. So waiting for it to drop further can be one of the strategies. But it is in the undervalued range right now from a long-term perspective. So this was the analysis. If you liked it, please subscribe to this channel for more such analysis. And if you want to read other stock analysis, you can log on to app.wisdomowl.ai and it is free. Thank you.